Debt is everywhere. Since everything is so expensive, the majority of the public must finance it with debt. Need a house? Get a mortgage. Need a car? Finance the payments. Want a George Foreman grill but can't afford it? Just charge it. Corporations do the exact same thing. There's just one problem. What happens when they can't pay back? You came here for the truth, so let me unveil that for you. This is going to be an interesting video. I'm going to get into some very deep data in debt, defaults, bankruptcies, and of course the economy. I'm going to show you what's happening as I record this video. The stock futures are rising high on hope. We've heard about hope for a long time. It doesn't actually make the engine move, but hey, why not? I've got several charts from Goldman Sachs. I'm going to get into some articles as well. Take a look at the corporate debt as a share of GDP rose significantly prior to what we saw in 2020. Bankruptcy filings have increased. Left-hand side, you can see the corporate debt as a share of the GDP. This has been going up for a long time. All forms of debt have been increasing, but we have also seen that taking place since the financial crisis, where it has grown tremendously. It's grown to a record high. Nobody wants to sound the alarm bells on this. Nobody wants to say it's a concern, of course, but it is because it's not immediate, just like Social Security and all the other unfunded liabilities, which are at least $100 trillion. This is important because what you can see in front of your face is not what's going on behind the scenes. And when you start picking it apart, it is a lot worse than the way they project it. On the right hand side, there are two lines here. You can see the Bloomberg BCY bankruptcies as well as the NACM filings for bankruptcies, and this is not looking good, of course. It just shows you what's been happening over the last little while. During the financial crisis, of course, we saw many different companies that were going belly up, small, medium, and large, and now today we are watching particularly small businesses that are getting destroyed by this. Of course, they'll tell you that they are creating this program and that program. They're going to bail those people out and those people, but ultimately it doesn't matter because the money goes to the big boys. Credit losses are likely to come disproportionately in the energy and industries directly impacted by what we're seeing in 2020. Our credit team forecasts a 13% high yield default rate, similar to the global financial crisis. Of course, you don't see this type of information being discussed by the traders, by the investors and analysts. They don't want to touch this. They know what's really going on behind the scenes, or at least some of them do, at least to this level. But what they want to focus on is what they have to tell their clients, their customers, and that is, now is the time to buy. I heard it with my own ears before. It doesn't matter what you sell as long as you sell it. And right then and there, I knew this was an industry that was corrupt to its core. Commercial real estate showed signs of overheating. Delinquency rates moved up sharply in recent months. On the left-hand side, commercial property price index, that's the dark blue line, and then you have the single family home price index. Both of these have clearly rocketed higher over the last few years. The absurd levels that we are seeing, particularly with the commercial property, is completely unjustified. And look at certain areas, for example, in New York, where the prime real estate, we're talking grade A real estate prior to 2020, boarded up, nobody wants to buy it. Nobody wants to be there. The prices are ridiculously high. The landlords aren't going to change that. It's a mess. It's a complete mess. And my favorite, the mortgage-backed securities, specifically commercial mortgage-backed securities, late payment rate. This was trending down for years, okay? We see that specifically going down on this chart. It did start to climb somewhat, but in 2020, it has spiked up north of 15%. Based on this, I mean, it looks somewhere around 17% or so when you're looking at the 30 plus days late. So it just gives you an idea of where we're at. And I think that people should be paying attention. This is all I'm trying to do on this channel. I find a whole bunch of stuff that I think is interesting that people should be paying attention to. I bring it to you and you do what you want with it. So many channels out there are giving financial advice on a daily basis. I think that is completely wrong, but that's just me. Delinquencies by property type show wide dispersion driven by exposure to what we are seeing currently in 2020. You can see the commercial mortgage-backed securities late payment rate by property type. Lodging is obviously going to be a big issue with tourism down to nearly zero. That is pretty obvious. Retail also hit quite hard. Office, I think this will change significantly in the coming months because while 2009 you could see it was significantly higher than May 2020, I think there's going to be a big shift into working from home permanently, and that's going to put downward pressure on a lot of these office buildings. Regardless, when you look at it all together, we are actually seeing that in 2020, it's higher than what we saw back in 2009. But we really shouldn't be comparing just the numbers. I just wanted to show you that. I think it's interesting. The situation is different when you look at what's happening in the detail, and so we should just take note of it. Banks are exposed to commercial real estate and overall corporate borrowing, two areas of concern. They're showing you the banks, the households, mutual funds, pension funds, insurance companies. They give you all the breakdown. I'm not going to bore you with all the details, but just know how this all works, because when you have these commercial mortgage-backed securities, they can create a huge problem for these investors as soon as you have the defaults. And we do see the defaults that are rising. We know that there's going to be corporations that go belly up. We know there's going to be banks that take major hits because of it, and how that all unravels, that remains to be seen. We don't know. If you see what happened during the global financial crisis last time around, it was very painful. Supposedly just a subprime crisis. Don't worry, it's just a small issue that will be controlled. And then what happened? The entire world was falling down. Banks are better capitalized than prior to the global financial crisis. Corporate and commercial real estate lending are significantly smaller than real estate lending. So Goldman Sachs just wants to tell you that it's going to be okay. You don't have to worry. They're going to take care of you. This institution that has its fingers wrapped around the government, the revolving door, of course, they are telling you that you don't have a reason to worry. So of course, why should we? Exposure of banks to at-risk industries appears manageable. Again, don't worry about it. Everything's all good. On the left-hand side, you can see retail, and we go healthcare, energy, restaurants, and so on. The percentages have certainly increased in 2020, no matter where you look. They're saying it's manageable. Certain industries, perhaps, but the longer this goes on for, the bigger the problem grows. Projected equity losses under our baseline assumptions are roughly half of the estimated equity exposure in 2008. The bar on the left-hand side is 2007. The one on the right is 2020. It just gives you a breakdown if you want to see that. We're looking at the potential losses, and I think it could be a problem, not right now. You have to think about how this all unfolds over a period of time. So many people are not going to be able to get their jobs back. So many businesses are closing their doors. You don't just turn that around. Credit Suisse will come out of the crisis needing fewer employees in the medium term as it faces the prospect of lower growth and looming credit defaults. Understand how this connects in. I'm trying to make it very clear. If you made it this far in the video, you know what I'm talking about. Credit defaults, that's a big problem. This particular bank is going to have to deal with that. What do? They lay off their employees. It's a very simple connection, but the media does not make that connection. Here at the Money GPS, I try to do my best to make these connections, to connect the dots. And when you see it, it's like a light bulb going off. Oh, okay, I get it. We don't have to just worry about Credit Suisse. We don't have to talk about the fact that, well, the percentages are lower than the global financial crisis, or at least that's what they predict, so we shouldn't worry. No, we see these as three separate points in the media, and all we're doing here is making that connection, and suddenly it is something that we should be paying attention to. They talk about how many people are going online. They discuss streamlining many processes, and of course, negative interest rates. All of this is leading banks and these financial institutions in a different direction, and that means fewer employees. Fewer employees, that means less people working at these jobs that are probably better paying jobs than certain other places that they can work. That's going to put further pressure on the economy if they can find a job. The retail industry is getting rid of people, so they're not going to be able to work there necessarily. If there would only be a big bigger group of people that were sitting down and thinking about all these things, I think we'd be in a completely different scenario. Japan launches its version of the Fed's Main Street scheme as deflation returns. I'm sorry, what are we talking about here? Did it ever leave? Well, Japan's central bank unveiled its own version of the U.S. Federal Reserve's Main Street lending program to channel nearly $280 billion to small businesses. This is important, of course, because they are further inflating what we have seen thus far. I just read that they were the biggest buyer of basically everything right now using April's numbers. You got to think about what this means. This is inflation. They are expanding the balance sheet at a level that is unbelievable in terms of the percentage of GDP wise. The Federal Reserve is technically has printed more money, but regardless, you can't restore yourself from this. This is not a solution. This is not success. Singapore banks seen facing lingering default risk in oil sector. So of course there's more to the story here, but I just wanted to show you that when we have particular problems, even if the time frame is limited, it could impact several companies, and of course that begins to unravel. Back in February, there was this article here. Junk bond scare is rising. No one cares. People are buying everything. And that's what we have to worry about. That when we have complacency like we did at this point, we should see this as a warning signal. We should be worried about the actions of everybody piling into the same trades. We shouldn't say, don't fight the Fed. We should look at this information objectively and make our own decisions. Doesn't mean that you're not going to buy into something. It just means you have to be cautious with your approach. That's all for this video. If you found it informative, hit that thumbs up button. When you do, you are supporting me. Thank you very much. If you want to check me out on Instagram and Twitter, I'm doing stuff on there every day. The Money GPS. Do you want to learn how to sell stuff online? Courses out there charge you $1,000, $2,000. For some strange reason, I have not charged for my course. It is $0 at this point. TheAmazonGPS.com. If you want to understand the financial system that's completely convoluted intentionally to prevent you from learning what you need to know, these two books will do everything, explain it all in detail. Check it out, link in description. If you want the audiobook, themoneygps.com. This is a very important video. I break down a lot of information. If you haven't seen it already, I recommend it. Click on it. I'll see you there.